Let's begin with the introduction to Green Community Housing Project.
Good day everyone. Today I'll be presenting the Green Community Housing Project in Malaysia. This initiative was developed in response to two major challenges, the rising urban population and the growing environmental issues. The project aims to provide affordable housing while promoting sustainable development. It aligns with the United Nations Sustainable Development Goals, specifically Goal 11, which is Sustainable Cities and Communities, and Goal 13, Climate Action. By integrating sustainability into housing, the project not only offers shelter to underserved communities but also promotes environmental sustainability. The goal is to create homes that are low cost, energy efficient and accessible to all, ensuring a better future for both people and the planet. This project focuses on three key aspects. First, environmental sustainability. It uses solar panels, rainwater harvesting and eco-friendly materials to reduce emission and cut household costs. This promotes green living in line with Malaysia's environmental objective. Second, social impact. It provides low-income groups with safe, affordable housing. Smart community designs improve air and light quality, while shared green spaces support health and social interaction. Lastly, economic feasibility. Funding is diversified through government subsidies, green bonds and private investors. Energy efficient system lower long-term costs and income from rents or sales help the project remain financially sustainable. Altogether, the project proves that sustainability can be both socially inclusive and economically practical.
Hi, my name is Hazanina Mao. So for my part is project overview and financial needs. Project scope. The Green Community Housing Project is a green housing development welcoming sustainability, efficiency and smart technology. The project, following the Ardent's Amber model, comprise double and triple story cluster semi-detached house measuring between 2,344 square feet and 2,790 square feet. The house will be built with reinforced concrete and green materials with a focus on saving energy and manage water. Land and development costs. The figure above show the current market rates of comparable projects such as Eco Ardens. The estimate cost in Malaysian condition are as follow. These prices are based on Eco Arden selling price, which is RM 2.06 million to 2.86 million, with developer margins which are usually 15 to 25%. So next is revenue generation potential, which is F3, rental income, sale of homes, and utility savings. For rental income is target middle to high end tenants in Klang Valley. Estimate monthly rent is RM 6,000 to 8,000 subject to unit type. Annual rental income per units, which is RM 72,000 to 96,000. More than 10 years with 2% annual appreciation, which is 1.2 million per unit. Revenue generation potential. And for sales of home is approximate sale price according to Eco Arden standard, which is 2-story, which is type A, RM 2.05 million to 2.13 million. 3-story type F, which is RM 2.49 million to 2.85 million. With green amenities, apartment can sell for 5 to 10% premium. Next is for utility saving. Solar water heating and energy efficient falls will reduce RM 300 to 400 in monthly electricity bill. More than 10 years, which is RM 36,000 to 48,000 per house in savings. If the unit is resold at 2.5 million with 3% yearly appreciation, net capital gain is 500,000. Total ROI in 10 years, which is 1.44 million or 72% return. Green Community Housing Project is a viable and profitable alternative for green development through the incorporation of contemporary eco-architecture, intelligent technology, and energy-efficient system. The project ensures a harmonization of environmental objects and sound economic returns. With the existing market comparisons such as eco-ardents, the project is feasible within reasonable Malaysian economic assumption and as a potential future green township model. That's all for me. I will pass to Elvin.
A very good day. I'm Erwan. So today I will be introducing the 5 possible financing options that might suit our project. So firstly, we have equity financing, which involves raising the capital by selling project ownership shares to investors, such as private equity firms or CSR funds. The next one will be debt financing. This is an option that where we borrow the funds from banks or development finance institutions, which also known as DFI, and repay them with the interest. The next one will be green bonds. Green bonds are also an option. There are special bonds that issue specifically to fund environmental friendly initiatives like solar panels. So we have also considered government grants and subsidies, which provide financial support or tax incentives when using the certified green materials or sustainable practices. Lastly, the last option will be the public-private partnerships or PPPs. This option allows the collaborations between the government and private developers, especially when it comes to infrastructure or public services. So among the 5 options, which option suit our project the most? So equity financing is highly suitable for our projects since our project has strong branding and sustainability features that might attract the ESG conscious investor and CSR driven funds. The debt financing is also suitable to our project since it enables us to cover large upfront costs efficiently. And the green bonds are not as suitable also since they are ideal for funding components like solar panel or smart home technologies and so on. However, the options like government grants or subsidies have limited suitability to our project only. This is because our project has a premium pricing and that makes the many grants are inaccessible to our projects. The PPAPS is also not suitable for our project since these typically apply to developments involving affordable housings or public infrastructure, which doesn't align with our project.
We begin with the cost-benefit analysis. The total capital investment is 12 million ringgit over 10 years. The total expected benefit is 98 million ringgit, while operation and maintenance costs are 501,900 ringgit. This gives us a benefit cost ratio of 4.42, which means every 1 ringgit invested will have a returns of 4.42 ringgit, a clear sign of high profitability. Next is ROI, which is return on investment, with the same 12 million ringgit capital and 98 million ringgit benefits. The project returns is 816.67% for over 10 years. That's an extremely healthy return and confirms the investment's high earning potential. The next one is break-even analysis. The break-even point is also very promising, with homes priced at 2.2 million ringgit. The project only needs to sell 6 out of 50 units, which is just only 12% to break even. This low threshold shows that the risk of loss is minimal and the profitability is likely. Now let's talk about risks. We've identified several key risks. The first one is high initial capital is the biggest concern. This can be reduced by using government incentives and phased development. Second one is market demand can be varied, but targeting Klang Valley residents with smart living features gives us a competitive edge. For material and labor cost fluctuations, we've included a 60,000 contingency plan. To address interest rate volatility, we recommend fixed term green bonds. And finally, risks related to technology policy and rental demand can be handled through proper design and partnerships.
My name is Jacob Tampeo, and now I'm presenting about the chapter 5, which is the financing structure and cash flow model. First, we need to identify the proportion of the total capital investment, which are 40% of equity, 50% of debt, and 10% of government grants or subsidies. We were using the net present value (NPV) method. First, we need to calculate the cost of equity (CAPM), which using the formula shown, and the B is the beta, which is the correlation with the market, is 1.2, and RF is the 10-year Malaysia government securities bond yield, which is 5%, and ERM is equity risk premium, is 10%. And using this equation, we can get the cost of equity is 11%. Next, we need to calculate the cost of debt. The cost of debt is the effective rate of company pays for current debt. I is 4.72%, which is the interest rate for public bank business financing we get from the research. And then N is the 10 years, and apply the formula and data, we can get that the cost of debt is 4.82%. Next, we will calculate the weighted average cost of capital, which is WACC. The WACC formula is shown in the slide. The E is the proportion of equity, which is 0.4. D is the proportion of debt, which is 0.5. RE is the cost of equity, which is 11%. RD is the cost of debt, which is 4.82%, while the tax rate we assume as 0. By application of the data and formula, we can get that the WACC of this project is 7.566%. Last, we will proceed to the NPV data analysis. The NPV data of this project is tabulated and shown in the slide. From the table, we can observe that the total present value from year 1 to year 10 is 16 million, while the net present value is 4.42 million. Uh, we can observe that from the table, the cumulative cost is turned to positive. The positive cost indicates that the greater project return than the discount rate we calculated in WACC. And then the investment is recovered from 6 to 7th year. Thus, the payback period is approximate to 7 years. In a nutshell, the project is financially viable.
Let's move on to the last part, which is conclusion.
The Green Community Housing Project is a sustainable and
Thank
financially viable
you.
development. It uses
Thank
a balanced
you.
financing mix of 40%
Thank you.
equity, 50% debt, and 10% government grants. Over 10 years, it projects 110 million in sales, 3.95 million in rental income, and 1.44 million in utility savings. With a BCR of 4.42, ROI of 816.67%, and positive NPV, it shows strong profitability. Only 6 out of 50 units are needed to break even. Green features like solar panels and water saving systems support national sustainability goals, making it a model for future eco-friendly housing in Malaysia. Thank you for lending your ears to us.